Hey guys, Damon Varial here, and today I'm going to show you how to get stock for free. So you can use this on any stock you like, Apple, Dollar General, which is the example I'm going to be using here. Anything that's popular, you can get for free. And I'll show you exactly how. We're going to be using Dollar General, which, full disclosure, I'm long on at the moment. And looking at this stock, we see that it's trading at about 72.50. So if we want to buy 100 shares of this, we need to spend $7,250. Now, a lot of people aren't willing to put up that type of capital for a 100 share position in a single stock. So I'm going to show you how to open it for free. As long as you have an options account that gives you enough ability to create custom trading plans here. So we're going to look at DG for this example. You can put in an option strategy that allows you to get that stock for free. What we're going to do is we're going to have two option legs, and I'm going to explain what this means in a second. So for now, just ignore the phrase option leg, ignore custom. What we're looking at is we're looking to buy open two options. Sorry, buy open and sell open two options. So we're going to do one each. Now what we're buying, if we want to be long on the stock, is a call option. And what we're selling is a put option. The expiration date should be the same. By the way, you could just go and look for whatever is most popular, and that'll give you a pretty good idea. Then you go to at the money. So whatever strike price is closest to the actual price of the stock is what we want. So we're going to do that first. Well, we have to do the expiration first. So we're just going to do whatever is popular. April 21st is a popular expiration date. So we're going to do that. And we're going to put in the at the money strike price. And now it's going to tell us how much this position will cost. And it's saying that it's going to cost us 30, that's the bid, and 10 is the ask. Now, if you add it up, basically, here, look at it this way. The last time this option was traded, it was traded at $300. The last time this one traded was traded at $305. Now, because we're buying this one and we're selling this one, they cancel out, and essentially you open this position for free. So it costs you nothing to open this position, and as soon as you open the position, you're now long 100 shares of Dollar General. So you've gone long for free. This is called a combo. This is a short combo, but a short combo means that you're long on the stock. Now, you're asking, what's the catch? How do I open this for free? Why is this possible? It's possible because you're selling one thing for the same price you're buying the other thing for, so they cancel out and become zero. And I'll show you in a second how you can change this a bit to make it even more profitable when you open it. But here's the catch. The catch is you need to put down margin. Now, margin isn't money spent on anything, it's just money you put into that account. So if you have an account already, you probably have enough margin to cover this trade. Now, the margin generally is half of the strike price times 100. So in this case, half of this would be roughly, let's say $40, and then times 100. So that's going to be $4,000. So instead of paying $7,250 for a 100 share position, what you've done is you've set aside $4,000 and got the position for free. Now you're saying, Damon, you tricked me. That's not for free. I have to put up $4,000. Well, I'll show you a way where you don't have to put up $4,000, and that's by adding another option leg. And you can control exactly how much money you put into the trade with this extra leg. What you do here is you buy open a put. It's already put in there for you. You buy open a put, and you want the strike price to be lower. Now the strike price, don't worry about the trade. It doesn't matter. The strike price here, the only thing we're looking at is how much you're willing to set aside for this trade. Instead of $4,000, we're going to be setting aside a different amount, and that amount is going to be reflected by the difference in these two strike prices divided by 2. So here, for example, let's say we go down to, what are we at? Let's go down to we'll say 65, all right? So if we go down to 65, the difference between 72.5 and 65 is going to be $7.5. Now, divide that by 2, and you've got, we'll say again, roughly $4. And now multiply by 100. Now you're only setting aside $400 instead of $4,000. So now you've got this position for $400 set aside, plus now it's not free anymore, but it's pretty close. It's going to be the difference between these two. Sorry, you add these and then divide by 2. So this is going to be roughly this is going to be roughly $65. So in total, you spent around $500 for 100 shares of Dollar General stock, whereas the stock investors spent $7,250. So this is a way to get stock for, technically you're getting it for free. Essentially, if you're using this second strategy I showed you with the 3 legs, you're paying a little bit and you're setting aside a little bit of margin. But if you're not using this, now you're just setting aside margin and you're getting the trade for free. And if you change the strike prices so that you're buying out of the money and you're selling in the money, now you're opening it for a net credit. So what it shows right here is that you are buying something for $200 and selling something for $500. You're being paid $300 to be long 100 shares of Dollar General. So that's better than free, right? And again, the same thing. There's obviously a downside to everything. So if you're being paid instead of getting it for free, what's the downside here? By changing the strike price, what did we actually do? Well, we raised that margin requirement. Remember, you look at the margin requirement by looking at the strike price, dividing by 2, and then multiplying by 100. That's roughly how you do it. Each broker will be a bit different, but that's roughly what you do. So if you're going to be paid $300, you've also raised the margin requirement. In this case, you've raised it $250, right? We raised it 2.5 and divide that by 2 and then multiply by 100. So we actually made money because this money goes in to your account immediately. So that could be set aside as margin. But that's how you do it. And this is called a short combo in case you want to look up more information on this. But you can do this with any stock. This is a really cool strategy that very few people actually know about. Most people just buy stock outright, or if they're going to play options, they just buy options, which is okay, but there's going to be a lot of disadvantages to buying an option versus that combo strategy I just showed you. The disadvantages of buying options is that you're losing money every day as you hold that option. The option decays in value. But when you have a combo like this, both of the options are decaying in value, and when you do it at the money, they're decaying in value at roughly the same rate. So this one's losing money, but this one's gaining money, and they're doing that at the same rate. So now you don't have to worry at all about time decay. You also don't have to worry about volatility changes. So you've got all of these things that hurt most option traders when they just buy stocks now gone from the whole paradigm. You don't have to worry about them anymore. You get the stock for free, and essentially what you're doing is you're just playing the option system that allows you to mimic a stock position but at great advantages. So if you have any questions about this, please let me know in the comments section below, and leave requests for videos, similar videos. Anything you want to do that's reasonable that you think would help many people would be great. Again, this is called a short combo, and thanks for watching.